Oops, didn't turn the phone off. Hang on. All right, how's it going, guys? Let's see what's going on today. Market made a spectacular recovery this morning, so we're in good shape. Oh, go away. Dun, 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 dun. Okay, everything's good. And let's see if anybody can hear me. Let me know if you're out there. And we can get this thingy going, hopefully. Sorry, I got a bit of a late start. And let's see. And we have to do the screen. No one can see your screen. Click here. And hopefully you guys can see me. And we're going to have fun and excitement and all kinds of good stuff. And let's see. Where's my thingy? La la la. Oh no, I lost my script for the machine to read. Hang on. I can't read this stuff anymore. Let's see. Okay. All right. Visuals. Do we have visuals? Yes, no, maybe. I hope so. Well, hello. Can anybody see my screen? This is me moving my mouse. That's not good. Not one person can see the screen. Or you're all busy somewhere else. Oh, they said we're good to go. Finally, somebody responds. Thank you.
Access to this webinar is for educational and
oh, way too fast, babe.
Consult a licensed broker
Calm
or
down.
investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacity as licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the website left parentheses. Right parentheses read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
I don't know why it doesn't read the things that are web pages. It skips over them. Weird. Anyway, all right, well, technical flaws aside, seems to be working well. Everything's good, market's good, oil's back down again. Don't know what happened. Something made it sharply drop. Up some news event. I don't have Newsmax on this computer, unfortunately. Do I? No, because we did that webinar with the Newsmax guy, and he was showing us on his machine. I don't have it on this computer, unfortunately. So let's see what else is happening. I was going to talk about some general stuff. We did our portfolio reviews on Friday. I think it was Friday. Didn't really finish until Monday. Things take me a long time to do. especially with all these positions, it gets really tedious. Oh, and we added a bunch also to the long-term portfolio. Yeah, we've been busy. We've been adding a lot of positions, and obviously the constant rise in the market isn't making us regret it so far. Daily, I mean, here's the Dow. You know, here's the last portfolio review. It was at the end of March, right? Towards the end of March. And we added a bunch of positions over the course of the month because the market just does not stop going up. And of course, it's going to at some point stop going up. But you know what else it was? It was also the VIX was crashing. And by the way, it always goes up when they roll over the VIX when it goes to the next contract, because it's not a real thing. The VIX is just a bet. It's like betting on a horse. So you're just betting where the VIX will be on a certain day, and these represent the bets of where people think they're going to be at the next expiration period. So generally, if things get wonky and people start betting the volatility will go up in the future, they start going like this. But if things calm down, and as you can see, since Biden's come in, it's been pretty on a calming trend. Just things are getting a little bit more relaxed, you know. So here's January spiked up a little in February, but down and then down, and keeps trying to come back, but not working out. So all this spike in the VIX here is because the contract rolled over again, and the projection is over the course of the next month we should be more volatile than this. But that's I put up an article the other day about gambler's fallacy. It was very good reading, actually. It explains it very well. The problem is people think, you know, there's a recency bias to when people look at these things and they go, oh, the VIX is really low. It's not really low at all, because when you zoom out to weekly, you realize that the VIX is generally 15. You know, that's around where the VIX should be. It's about 15. You go longer term, and we could be all over the place, but this is the entire last decade. We're hardly ever over 20. You know, and we could be down at 10. But basically 15 is about the normal amount for the VIX, you know, if you bisect the line right about here. So you know, just because, again, to look at this time back in 2008, 2009, VIX spiked up crazy, and we had a couple of echoes, but basically it just started going back to normal. If you go 100 years back, you know, this is how it is. So normal volatility is in the 15 range, and everything else is not normal. And that's what makes shorting the VIX such a great play when it does spike up. But again, it's relative. So, you know, when the VIX took off here, I was all for shorting it, and I very rarely am. But then when it comes back down around here, it's kind of hard to short because it could go up, it could go down. It's not, I don't have any fun betting like that. I like to bet when I'm pretty sure it's going to go one way or the other. So we'll see. You know, so far earnings have not been terrible. You know, some isolated incidents of terrible, but not too bad. And we're going to see how things play out. But back to this. So we were doing our portfolio review. We're still plowing along, making new highs. So there's no reason to not invest. You don't want to miss out on a huge rally. Oh, that's what I want to look at on that chart. Where'd it go? Nope, that one. How far back do these things go? Well, there you go. What a great example. Okay. So, you know, in 1999, we pretty much thought that you couldn't get any higher because we had already had a huge run in the 90s, probably 100% run in the 90s. But in 1999, in that actual year, we actually gained another 50%. We went up from 1,000 to 1,500 on the S&P. And it was crazy overvalued. And then it took us, we had a correction, and then it took us 10 years to get back to where we were there. And then we had another correction, and then it took us not as long, 5 years to get back to where we were, not even 5 years. But since then, since 2013, look what's happened. We go from 1,400, there's your double, and 4,500 is another 50%. So we are really in crazy territory now. But and by the way, if you were looking at this in an isolated thing, this would look kind of like that. Well, this is what 1999, obviously 50% in a year, right? So what does 50% in a year look like? It looks like this. That's what 50% a year in. So when you're there and it's in that proportion, you would have seen the same thing. We went up in 1999, 50%, and then boom, everything collapsed. So, you know, the end of the rally can be a great time to invest. And in 1999, the government wasn't putting trillions of dollars into the economy to have a recovery. You know, even after 9/11, the government did stuff, but nothing like what's being done now. I mean, now it's just incredible amounts of, you know, stimulus money is going all over the place. And I don't, what? Stop telling me things. And I don't want to say it's a new paradigm, but you have to accept the fact that possibly this unprecedented action can extend an unbelievable rally to even more unbelievable proportions. You know, and see, here's the monthly candle. You see how this one like sticks up drastically. That's the last month that we've just been playing. And in that last month, we got a little bit busy. We added a bunch of things to the long-term portfolio. Did I list what they were? Yeah. We added, in the last month, we've added Boeing, Big Lots, Chimera Investments, Discovery, the credit card, Facebook, PHM, Pulte Homes, QSR is a restaurant, Popeyes and Burger King, REYN, I forget what the hell they're called. That was suggested by somebody else. I think Yodi suggested that. Maybe somebody suggested it anyway. So not one I usually play, but it was a really good idea. Oh, Reynolds Consumer, right? That's what it was. So this is Reynolds Consumer Products, excellent, you know, great basic company trading at what says now 20 times earnings, but it really isn't 20 times earnings because they can earn much more. So that, by the way, see, never, you know, you can't ever look at these numbers and think that they're right. You know, just don't assume that they're correct. What is correct, they have a $6.5 billion market cap. But then I would say, well, how much do they make? Why, you know, is that really 20 times earnings? Because when they can be really out of whack with reality. So, REYN. So 6.4 billion market cap, yes, but what do they make? Why are they 20 times earnings? Are they making 300? Are they making $300 million? Here's 2020, 363. But we know this is a bad year. You got to take that into account. You got to see what their normal earnings would be, and their normal earnings would be. Well, this was actually not a bad year considering, but they're 300, 176, 225, and here, but they just broke out. Reynolds is a breakout company, and so they're expecting to kick in and move up to about 400 million, and that makes 60. How much was it? 6.4. That makes 6.4 pretty reasonable, and they're a growing company who are pushing forward. So on the whole, it's a reasonable thing. Now, what do we do with it? The way we added the position, gotta refresh this portfolio, I think. No, I don't want to take a survey. Okay, so REYN, the way we took this position there, and what did we do? We did the 25-30 spread. We did not play this aggressively at all. We just said it was fairly valued. And you see how I came to that conclusion. I went and I looked, I said, what do they really make? And I'm like, well, they certainly make enough to be, I'll pay, even if they only make 300 again, I'm happy to pay 6.4. That's not terrible. So as long as they don't go lower, we're in good shape. That means that generally they're a bit undervalued, but not drastically undervalued. Therefore, we played this with the 25-30 spread, just a conservative little play to keep our eye on it. If they get cheaper, I'd be pretty interested. But even this very, very conservative play on the March 25th, which is what, a month, not even a month ago, 3 weeks ago, basically. So on March 25th, we picked up the December 25-30 spread. So we just saying till the end of the year, it's going to hold $30. And we picked that up for a net cost of, that would be 6, but 2 less than 6 is 58. Wait, oh yeah. Half of 58 is half of 11.6. So 5,800 minus 1,400 is $4,400. So net $4,400 for this spread. And if it all goes well, it's going to pay $10,000, 20 of these. So it's a $4,400 spread that can pay $10,000. And look what happened already. It's already up $2,000, $3,500 basically. That's crazy. But that's because we played it conservatively. You don't need to play for things to hit the sky to make a lot of money. What is this? Is this monthly? I'm going to say this doesn't look right. All right, so March 25th, it was roughly here at 30, and now it's at 31. Didn't move much. All right, one of the reasons we made the money is that the VIX went down, and since the VIX went lower, and we sold a lot of, how much premium did we sell? We sold $7,200 worth of premium. And then the VIX went lower. So the premium went lower. And so this $7,200 dropped to $5,500. And that's where a lot of the profits came from. But that's what we do. We just leverage a good position. And it's not about picking a stock that's going to go up 100%. We could care less. Flat is great for us because we can devise plays that'll pay us 100% on a stock that goes flat by using the options. What else? So I got caught up on that. So Reynolds, UBS, the bank, and ViacomCBS, who we liked and got cheap again. I think they got cheaper since also. I don't think they're doing so good. But we're waiting for earnings on that one. Oh, finally found a floor. Yay. You know what it is? Because look, we added Viacom when? And again, we played Viacom already. We got in and out. Well, there they are, way up there. So March 29th, we added Viacom. That was my birthday. And we were aggressive because we have 15 longs and only 10 shorts, and we have a big spread, 40-60. This is a different situation because with Viacom, we're playing this aggressively. Why am I playing Viacom aggressively? Well, go back and take a look at what the company looks like. And by the way, it didn't take me any time at all to do this because we already played, we played Viacom already this year. So this is our second time around. Why? Because it's back to where we liked it last year. It's the 2-year chart, whatever. We've been playing Viacom since it crashed the first time because it got so stupidly cheap at 15, 16 bucks. We were like, boom, boom, boom. And I couldn't believe the whole time it was like laying down here. And I'm like, how the hell can it be so low? Then it went crazy the other way. So we got out. We're not stupid. I'm like, you know, when it went up past 60, I was like, get out of this thing. It's ridiculous. And it was ridiculous. Now it's back at 40. But we think 60 is the right price. We think it should eventually hit 60. Why? We're at 24 billion now, right? At $40, it's $24 billion. They make $2.5 billion a year. And that's not even a heavy projection. They've made much more in the past. They've made 3 billion, 3.3 billion. So they're making 2.5 billion, and you're only paying 25 billion for the whole company. I want to be in a stock like that. I think that's low. I think that eventually they'll drift up to a 12 to 15 PE, and we're going to make quite a lot of money on it. And how much is 12 to 15? Well, we're at 10 PE now. 12 PE is 20% higher than the current price. That'd be up $8 on the 40. So 48, very reasonable amount. What do we do the spread for? We picked up the spread for 26 minus 6 is 20, minus 12 is 8. We picked up the spread for 8, whatever, it's $8,000. And that means 48 with 15 would pay us $12,000, right? So we're going to make 50% on this put if we just get to 48. If we keep moving up to 60, this becomes a $30,000 spread. So, we look for stocks that have that are good fundamental values. That's our first thing we're looking at when we're picking a stock is this stock a good buy? But we don't need it to be a growth stock. We don't need it to be, and that's the thing, you chase after these growth stocks and they're already priced high. Like when this thing is 60 and people are buying it for whatever reason. So people are still buying at 60 and they think it's going to go up, and it did go up, fine, but over the short term. But we're more, if you want to be a long-term investor, we want to know if it's fundamentally sound over a period of time. Because if you buy at 60 and you need it to go up to 70 or 80 or 100 to make your money, I don't want to be in those kind of stocks. Why am I overpaying for something? Well, I'll just wait. And that's what we do. We just wait. We wait for a good value, and then we move into the stock. It's a very simple way to play. And a good value doesn't mean that the stock has to be expected to go up in price. See, that's the thing people miss a lot in our portfolios, is that we're not always playing for a stock to go up. We're playing for it not to go down. Because when you learn to sell options premium, you don't care if the stock goes up, you only care that it doesn't go down, because you're effectively buying it. It's like a house that you intend to rent. Your position, your long position, is your purchase of the house. The short positions are like your rentals. And as long as your house doesn't lose value and you can keep renting it out, you will make a profit. The only problem is, will it lose value? And that's why people love real estate, because that's what you do with real estate. You buy a house, you rent it out, you buy property, whatever kind of property you rent it out. And the general theory is that the property will appreciate in value. So if you're paying off the mortgage, eventually you'll end up with a nice little nest egg. And it usually works in most markets, most years it works. We had a particularly horrible crash 10 years, more, 15 years ago now, or whatever. Wait, what? When was that? Well, yeah, like 15 years ago now. We had a particularly horrifying market crash in housing. Things have crept back up now. We're back to about the levels we were before they crashed last time. But I don't think it's necessarily a bad thing now, because we're at those levels with inflation rising, prices rising, wages rising. It's not the same thing. We're not in the kind of bubble of housing that we were in. In fact, if anything, housing may be a little undervalued. Not rich people's housing, that's back in the bubble, but regular housing is not so bad. So we'll see how that works out. But anyway, bottom line is we added 10 new stocks in the last 30 days. We still have $1 million of cash sitting in this portfolio, and this started out as a $500,000 portfolio, so that's pretty impressive that we have $1 million in cash. So 200% of where we started is in cash, and I think the whole portfolio is like 1.8-ish or something like that. 1.8, yeah. So, in fact, here you go. So obviously I haven't made any changes since we did this review, because even if we added a position, I wouldn't have gotten around to it yet. So we were at 262%, 1.811 on Friday, and today we're at 1.839. So that's $28,000 gained on these positions since Friday, and it's only Wednesday. And that's because all the market has to do is not go down, and we make money every single day. So, and we've only put well, we have $800,000 at work. So the positions are only $800,000. We have more cash than we have positions. So we're really, really ready to deploy. And that's after we added from the previous time, from last quarter, we added 10 new positions and we still have $1 million left in cash. And we have 800,000 in positions. Those 800,000 in commissions made $28,000. And I don't know what the math on that is, but that's pretty freaking good for whatever amount of time this has been for a few days. Well, obviously, right? Oh, that's a calendar. Hard to calculate with a calendar. Calculator, there you go. That's more like it. Well, I guess the Mayans used to calculate with a calendar, didn't they? So there is a trick to it somehow. What did I say? 28 divided by 819. Yeah, 3.4% in less than a week. So, and what is that all about? That's all about the decay. In other words, if I sell, you don't know whether your stock's going to go up or down, right? Because these are the variables of running your portfolio using options. You don't know whether your stock's going to go up or down. Could go either way. So we eliminate that risk in two ways. Way number one is we pick stocks that we feel are very, very strong values. We do not buy anything. No, I don't want to say nothing ever, but we really try to buy things that are less than 20, that are making at least the price earnings ratio is going to be about 20 or less. That's my magic number. I want to see 20 or less. Now, sometimes I'll stretch and I'll say, okay, well, they're growing so fast that they should be at 20 in 2 years, and then I don't mind making a 2-year play on it because we'll get there. I don't like that, though. I really prefer to find things that are trading under 20 times earnings. Now, the entire market is trading at 35 times earnings on the average. So that means there's very, very few things you can buy that are trading at 20 times earnings. This is a portfolio full of those. Well, no, I'm sorry. I don't want to say the new stocks are full of those things. Some of the older ones obviously have increased so much that they're no longer in that range. But you can easily just look at the range of these stocks and look at what we intended to be at. And like Pfizer, we said 30, 37, Pfizer's at 39. They're at the top of our range already. PBR though, we took a 5-10 spread, so we think it'll hit 10 eventually, and certainly, the put, that's actually the best way to know. If we're saying a put, that's what we think is the least it's going to be. That's our value play. It's a put. And so when I say Facebook 230 put, I don't think Facebook's going lower than 230. Of course, it's at 300 now, so it doesn't matter. Cisco, we sold the $25. Well, that's completely in the money. So we sold the $25 put on Cisco. Big Lots was a recent one. We sold the $40 put, but it's at 65 bucks. So what that actually indicates is not that much faith. We are certainly have a concern that Big Lots could crash down on us. It's doing well right now, so it doesn't matter. But the point is, we buy things that are good value. Oh, and here are just the puts at the top of the long-term portfolio. These are just the stocks where we sold puts at. So obviously anything, here you go, Boeing. We sold the January 200 puts on Boeing. Boeing has had a bad time since we got in it, which was when? Which was 4/13. Oh, we just sold that. So what did BA do? Do they have earnings? La 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 la. See, I get distracted by details. Boeing. Earnings April 28th. No, not yet. I guess it's because of the poor airline earnings reports, is my guess. They got a deal to make Apaches. They're looking. They're gonna. Oh. Ha 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 ha. Oh, I didn't know about that. Wow. Why is nobody seem to care? The U.S. Transportation Office Inspector General will audit the FAA's decision to unground the Boeing 737. Oh man, that's. I wonder why. Is that just a regular review? Oh, their chief financial officer is retiring. No dividends. That's another one. Interesting. So they have management changes, things like that. Yep, CFO shock retirement. Yeah, people don't like that kind of stuff. So we don't care about that. That's not a big deal. I mean, unless he retired because of a scandal, but it wasn't a scandal. What was I going to say? Boeing. Why was I looking at that? Shit. Sorry. Lost track. Positions. Oh, because of this, right? Okay, so we just recently took that, and they took a little dive because there was bad news and it dropped down. Now, that doesn't put us off because honestly, I mean, we want to own Boeing. This is for 500 shares of Boeing, 5 contracts, January 200 puts, and we sold them for $23. So that means our net entry, we collected $23, which was $11,500 in cash. And our obligation is to buy 500 shares at 200, but then when you subtract the cash we got, we'd be net into Boeing for $177. Now, in no way, shape, or form do we think Boeing's going to be below 177, unless, of course, they reground the 737s. That would be terrible. But if they did, we'd probably stick with it and set up a longer term play because whatever issues they have, they'll eventually work them out. But anyway, so there you go. So there's an example of one you could absolutely go right now. Discover Card, you know, it not doing badly, but it's weak. It's still basically where we entered it. So that's still good for a new one. Who else is small? Only a small gain on OIH, on the oil services. Still probably a good trade to play on the ETF. Frontline Tankers, yeah, that's probably a good one too, still available. But that's what we do. We sell these puts to say if the stock gets to this price, then we are interested in buying it. And if not, we'll keep the money that we sell the puts for. And then Chimera, we like for the dividends. Total, we like for the dividends. And I like them as a company. That's a great company. And anyway, so we reviewed all these on Friday with all of my commentary. I'm certainly not going to go over everything again because we'll see. Basically, every single one has been commented on at some point. And I forgot the calculation, but there is a very, very large amount of money left to gain in this portfolio. Let's see. Okay, so upside potential, let's see. So our upside potential is $700,000 or about $50,000 a month going forward. So in other words, last time, if you go back to the previous long-term portfolio review, we actually did a more, you know, every quarter or so, I'll do a detailed review where we look at every position, say, here's how much money this position will make, here's how much money this position will make. And by the way, if you don't know that about all your positions, what are you doing? Well, why would you hold a position if you don't know how much you expect to make? It doesn't make any sense. How can you track it? How do you know if you're doing well or doing poorly? So we know with the long-term portfolio, we expect to make about $50,000 a month because that's the sum. We've summed up all our positions. We know how much the total potential is. And 700,000, this is over 2 years, of course, 700,000 between now and 2023 is roughly $50,000 a month for the remaining amount of months. And what was I going to say? Yeah, so it's like 18 months, 17 months, whatever it is. And that means that making 28,000 in a week is too much, right? You shouldn't have made 20. Why do we make 28,000 in a week? So you have to think to yourself, it's not outrageous, but I mean, we had a good week, right? Obviously, we were only supposed to make $12,500 this week, and we made 28,000. So the market is racing ahead of our expectations. Now, the thing about that is, though, if your portfolio is outperforming, especially, we know that we're limited to 700,000. Not limited, we can change things, but basically because we've sold a lot of calls, we have a lot of covered positions, we really don't go higher than 700,000. So if we realize in 1 month $200,000 of that 700,000, that means for the whole rest of the next 16 months, we can only make 300. We can only make $500,000 more on a $2 million portfolio. We have to rethink the whole thing. We're so far ahead of our projections that we probably have to redo something drastically. And in fact, that was what was happening because, in fact, I explained it here. While the LTP gained ground, the STP lost. We gained $109,000 in the long-term portfolio in the previous month. And remember, we're only supposed to gain 50. That meant our future profit potential dropped to $560,000. So to balance that out and get back to a reasonable amount of bullishness, as I said, you got to do drastic stuff, right? We added 10 new plays, and those 10 new plays make $140,000 if the market keeps going up, or at least stays flat. Because of course, like I said, we really don't need the market to go higher, mostly just need it not to go down. And so we, by adding $140,000 worth of new profit potential on those positions, now we're back to 700,000, and it's worth playing. And I know that sounds really snooty, but it's like, you know, we are capable of making phenomenal amounts of money using these techniques. So there's no reason to not make it. The only thing is, though, that you have to realize it's not always a good time to play this way. We have a very, very different strategy that we perform in a weaker market. And also I want to emphasize, which I emphasize in this portfolio review, I want to emphasize that if it wasn't for the fact that we have a short-term portfolio that is full of hedges that protect us, that actually give us almost $500,000 worth of downside protection, I wouldn't feel comfortable with what we have here. It's only because we have the protection, right? It's like if you go out on a driving range in a golf course and you're just walking along the driving range, you're going to get whacked with balls, right? But if you go out in one of those cars that has a cage around it, then you're still going to get whacked with balls, but you don't care. That's what this is. This is a cage around your portfolio. You have to have hedges that are going to protect you, because this is going to be a rough market going forward. And in fact, we talked about that this morning, because who was that had it? Where was that? Oh, okay. So Mike said, what did Mike say? So Mike said Grantham from Jeremy Grantham from GMO Capital, they have a 7-year forecast. They are not predicting a good 7 years. This is their prediction for 7 years going forward. They think US stocks are going to fall 7.3%. US small caps 8.1%. So they think the next 7 years, the rest of this decade basically, is downhill. And they don't see, and there's no safety in bonds. There's no winning in this thing. But you know what? Down 7.5%. That's right in our wheelhouse. We don't care. When I say, when I say flat, 7.3% down is fine with us. We don't care if we lose. In other words, I don't care if my house that I buy for $50,000. If I buy a house for, well, 50 obviously silly, but if I buy a house for $500,000, looking at real numbers. If I buy a house for $500,000 and I rent it for $3,000 a month, okay? So I'm going to get $36,000 a year back on my $500,000. Now, you can look at that two ways. So 36 divided by 500. So I'm getting 7.2% return on my cash, on my what I put in the house, right? Obviously repairs, painting, blah, 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 but let's just say 10 years. So if I have a $500,000 house, and I rent it out for $3,000 a month for $36,000 a year for 10 years, that's minus $360,000. So I'm left with $140,000 and a house. So I'm sorry. No, I'm down, I'm sorry. So now I've spent $140,000 for the house, okay, net. I got back 360 of the 500, so I have $360,000 cash. So I start with $500,000, I buy a house. I rent the house for 10 years. At the end of 10 years, what do I have? I have $360,000 in cash and a house. So if I cash in the house for $500,000, then I have $860,000. Pretty obvious, right? And I've made 7% per year. That's how much I've made. That's a reasonable rate of return. Now, in reality, you don't actually put down, this is what options are, right? In reality, you don't really put down $500,000 cash, right? You buy a mortgage. You promise to pay the bank much more than $500,000, actually. You pay them more than that over the time, but you promise to pay the bank, and the bank gets you the house, and you can still collect your $360,000. Now, let's say you put in a 10% deposit, it's $50,000, let's say 20. Let's say you put down $100,000 cash. You still collect the $360,000, right? But you're also going to have to now pay a mortgage. Let's say the mortgage is $2,500 of it. So let's say you're only collecting $500 a month, so you're going to only make $6,000 a year in actual profit. And again, we're ignoring fixing the house and whatever, but you'll make $6,000 a year in profit. So now you started with $100,000. Now you're going to get $60,000 back over the course of 10 years, right? Because the rest goes back to the bank to pay for your mortgage. You have and so now you have $60,000 and a house. But if that house is only worth $500,000, you got a big problem, right? Because you're only going to have $560,000. You still owe the bank, $350, whatever, to pay it off. It's not terrible, but it's not great. But that means your margin of error is very small. You have to be very careful. That's what we do with the options. So we are doing that essentially. We are taking less cash, and we're creating a situation in which we don't actually own the stock, but we kind of own the stock. We have the right to own the stock, and therefore we sell or rent out the stock, and we still collect the money. You can do it with cash. You can buy the positions and do the same thing and make your nice 7% returns. And since 7% kicks the crap out of what you're going to get in bonds or the bank, which also are not predicted to do well, then it's a good defensive way to play everything. Because again, we don't know for sure it's going to go up. If the house, obviously, if the house becomes worth $1 million, all your problems are solved. Nothing matters. But what if it isn't? And then how are you more screwed? Obviously, you're much more screwed if you're renting the house and you have the obligation of the bank. And at the end of the time, the house went down 20% in value. Now the house is only worth $400, and you're giving $350 back to the bank. You've only collected $36,000, so you have a total of $536,000, and you probably need. And you put $100,000 into it. Don't forget. So if you can only sell the house, if it's $536 and you can only sell the house for $400, then you've got $136,000 left from your $100,000 investment. That sucks, right? If you put the cash in, because who took the money? The bank. The bank made all the money in that situation. The house goes down, the only person who made the money is the bank, because you promised, same thing as when you sell a put, you promised the bank you'd pay them this much for the house. You were betting it would go up. It didn't. See, that's what hurts you in the long term. But that's what the portfolios are based on. So the idea, obviously the same idea with the house. Don't overpay for the house. Don't overpay for a stock. Because you don't know what the hell it's going to be 10 years from now, but you do know how much you can rent it for. That's the qualifier. We know for a fact that we can rent out our positions. And then we know for a fact that at the end of every month, we've got the money, and the person who paid us the money the renter has nothing. They have to rent it again. They never own the positions. We own the position. We control them. So we can own them for cash, or we can own them using options. You own them for options, be careful, because you can end up losing money. You can also end up with better leverage and making money in the same situation. Obviously, when you only put $100,000 down, if the house goes up 20%, you made a freaking fortune. House goes up 20%, $600,000. You collected $36,000 net in rentals after paying the bank the mortgage. And so now you have $636,000. and you owe the bank the same 450. So now you made 200,000 on 100,000. That's what we do. That's why and that's what I'm talking about. That's why it's ho-hum. If we're only making 50% on our money, that's a pretty ho-hum way to play. But we want to be, before Grantham agreed with me, this was my projection too. I don't think we're going higher. We don't have the earnings, the actual money is not being made to support the market where it is now. Therefore, you have to wait for that to catch up, and that's going to take a while. Well, what's Biden talking about? Biden says we still have a long way to go on the vaccination effort. Yeah, no kidding. Up 200 million COVID. What? I imagine he needs vaccines. So apparently we vaccinated our 200 millionth person. Very nice. Okay. So that means, really? No, I think that has to include, I think that means people got 2 shots. I don't know what the hell he's talking about. Let's see. Biden. Ad block has been updated. So you want me to pay for it? Oh, you bastards. Not now. Bad timing. I do like it. Oh, we're going through this bullshit again. Oh my God. The Republicans, it's like the healthcare thing, right? The Republicans claim to have a better infrastructure plan, but they won't tell you, it's a secret. So they don't want they don't want Biden's plan to go through because their secret plan is better. It's exactly what they did with the Obamacare. So funny. So Biden's already gone through this crap with them, so he's not going to put up with it. Oh, pay attention to this. President Biden's plan to cut emissions in half by 2030. And what year is it, kids? 2021. This is a 9-year plan. Would require us to transform the way we drive, heat our homes, and manufacture goods. This is now. In other words, if you want to get there by 2030, we have to make drastic changes every year now. There's an incredible investing opportunity, right? If he starts passing laws, that means that whatever the frick kind of changes we need to make, they have to start getting made on an annual basis. And again, it goes back to the same thing. You divide the amount of things that need to be changed by 8, and that means every year this much has to be changed. 10% of the things have to be changed. And this is an incredible investment opportunity. Yeah, and we're off to a climate summit too. That's nice. Isn't it like Earth Day or something on Thursday? Okay. Cut greenhouse gas emissions in half by 2030. House to vote on to limit their. Oh wait, the House is. Wait. I'm trying to find out what Biden's saying, not what everybody else is saying. White House spokesman. Big thing. It doubles the pledge that Obama made to cut emissions 26% by those levels. Well, the country would have more years. 2030 cut emissions 50% from 205 levels. It will not include detailed modeling showing how the United States pros and meet this pledge. It will not include detailed modeling to show how we'll. So this will be something you got to watch. How are we going to get there? Now I got to tell you guys, I am very, very, very pleased with carbon capture. This is kind of funny, actually. Exxon, what? Really? No, I'm not even going here. Sorry. Anyway, so there's some good stuff on it. You can look it up. But carbon capture, and the big oil companies are now going into the carbon capturing business, which is so funny, because they're the ones that put all the carbon into the atmosphere, and now they're going to charge us to take it out. But I don't really care. I don't really, you know, you can say what you want about it, but the bottom line is, hey, if they can figure out how to get the carbon out of the air, and I'm telling you, they want to get it out of the air so that they can then put it back in the air again. But that won't matter if they can always take it out. It's sort of like renewable resource at that point. So the carbon goes into the atmosphere, you capture it and put it back in the ground, and then you sell it to people again. You sell them the same stuff that you sold them last time when they burned it. But that's kind of cool. But yeah, carbon capture, there's two kinds of carbon capture. First, carbon capture is like stopping it from leaving the smokestacks and whatever in the exhaust and so on and so forth. But they're also talking about building massive reverse wind farms, basically, that will suck the carbon out of the air. Basically, you're like running the air of the planet through a filtration system, and they will pull massive amounts of carbon out of it. And that's pretty cool. So I'm very happy with that technology. It's coming on much quicker than I would have thought. And this can actually really make a big difference in global warming. So obviously very important for what Biden's doing, because God forbid it doesn't work, we're screwed. But we can be very unscrewed and in much better shape than we thought we would be if they can pull some of these things off. So there's a lot of cool stuff being worked on massive scales that, you know, hey, cross fingers, right? And all of it works. Also, we're gonna have fusion, which we already knew was on schedule. Looks like Lockheed Martin's not winning the race though at the moment. That was one I really liked. All right, let's see what else. No questions. All right, great. I can just keep rambling on about random stuff. Okay. All right, what else are we talking about? Oh, well, mostly I want to talk about the new stuff and say, look, you know, here, AT&T, another bargain, right? You know, we do our top trades pretty much every week. We just did TD Bank this week. Last week was Big Lots. Viacom, talked about that. CIM, NLY, there were two of them. One went in the long-term portfolio, one went in the dividend portfolio. Viacom, again, I didn't realize I'd done that twice. So it's so cheap. Well, the thing is, it got cheaper, right? It was compellingly cheap on March 29th, and then it got cheaper. So I'm like, oh, pick it again. I'm not a little ego about this. It's like, damn it. It got, where was this? On April 12th. So March 29th, we picked it. And then on April 12th, I said, hey, this is still cheap. Here's when we pick QSR. See, a lot of these things you see in the long-term portfolio, they were top trades at the time. So it's not like you're going to miss them. Yeah. And for that, anyway, for those of you who don't know, we have if you're in PhilStockWorld, we have the top trade alerts. So you can always click right there in the top right to find those. Just quickly tell you, because if you're not a member, because Andy reminded me some people are not members, so I should click become a member. And it's going to show you, this is the landing page telling you more about the service in general, but there's a whole bunch of things. So if you want to become a member, click here, and you click there, and it takes you to this page where you can sign up. So the top trade membership is this one. It's 149 bucks a month. And like I said, all these trades that we're talking about, not all, sorry, many of these trades that we're talking about end up being in the top trade alert. If you want to see more, there's the Trend Watcher membership that lets you view the live member chat room. You don't get to ask questions, but you can see what everybody's talking about. And that's where every single trade ends up in the chat room. So you'll see that you're on a 1 hour delay, you know, so you don't get immediate access to everything, but you know, 1 hour delay, it's not so bad. And you get to check out all the commentary. But the top trade though, I mean, you know, I got bored tracking it because it was always about the same, but I mean, we are like, we're like 70, 80% successful on our top trades. So like 4 out of 5 of them end up making money historically. So I mean, that's pretty freaking good. I don't really know anybody who does better. Let me know if you do know somebody who does better than that. Anyway, Facebook is another one that we like. But now keep in mind, this is back in March, and since March, we're up quite a lot. So you got to be careful about where it moves since then. Pfizer, of course, that's a no-brainer. Wow, look at Pfizer, March 9th. So here's when I picked Pfizer, 34. Now it's heading up to 40. And everybody here knows Pfizer was our first COVID pick. When this whole COVID thing started, I said, oop, let's buy Pfizer. Oh, Gilead, I'm sorry. No, Gilead was first, then we moved to Pfizer. Because based on what I knew about Gilead, because of the treatment, that's why they have the treatment for the remdesivir or whatever the heck it's called. So that was the most likely thing to treat COVID. We figured that would be important, but when we got to the vaccine portion, Pfizer was the most likely one to be able to come up with a vaccine, and it worked out. Here's Gilead too. But this is this year. I mean, Gilead just got cheap in March, so we jumped on it. This is March 1st. See what happened to Gilead? They had a big crash here, and on March 1st, we put our foot down and said, that's too low, and now it's back up. It's not complicated. Shorted Wayfair on February 25th, and that's right about where it is now. It went up since we shorted it. Now it's coming back, and oh, okay, now it's working. Good. All right, so I don't know what happened there. Top trades money, inflation hedges. Wow, that was a good call. Holy cow. I got to tell you, I'm pretty impressed with myself sometimes. So here we have a nice call on February 8th for inflation hedges. And I had 4. So see, sometimes, it's like, we might only do one trade. We might only do about one trade a week, but when we do 4 in one trade, that's a good deal. So wheat and precious metals, this is started from February 8th. So here's wheat and precious metals was here. It went down a bit first, and now it's coming back nicely. What was a stock of the year for us in 2017, 18, something like that. See this funny, because we, again, I always go back to the well. We know what's a good value. GOLD is Barrick Gold, and another one that was a stock of the year. Actually, it was a stock of the year last year, so it's pretty recently. So we know exactly what they're worth, and as soon as they got back close to 20 bucks, we grabbed them. OIH is oil services, and they're back around where they started, so that's still a good trade right now. And Valero is they shot up, but Valero went up a good 10% since then. They went up ridiculously. I don't even understand that. But that is our target. Notice our target is, we don't pick these targets out of our asses. It's like I pick 80. I'm a very good targeter, frankly. And we picked 80. It got to 80, got rejected. So it's at 80. I'm saying in 2023 it's worth 80. It's going to 80 now. But the same logic that drives my pick is going to drive the valuation of other people, because it's not like I don't value things out of my ass. It's like I used to get paid to tell people what the value of things were. So, which I guess I still am getting paid. But people used to ask me to analyze things for them all the time, and my metrics aren't that different than any major investing house is going to use for metrics to look at things, and they're going to come to generally the same conclusion. So if it goes to 80, gets rejected because it's not really worth 80, not now. It's going to be worth 80, but it isn't worth over 80 now. Therefore, it's too high. Therefore, it gets rejected. Therefore, it sells off. But that's no big deal. We don't care as long as it's higher than what we need it to be. And here we sold the $50 puts. No worries there. This whole trade, 20 minus 10 is 10 minus 4. So basically $5,000 net, which means our break even with 15 calls is less than it's not 65, it's like 67-ish basically. So let's say 67. So our break even here is $67 to get our money back. And no, I'm sorry, it's $5,000. No, I apologize. It's only 5,000. So we only need 63. So we're break even. 63 is going to be $7,500. That's already a profit. So 62, 63 is our profit zone, and we're way above it. And that's all we need. And again, we took the trade February 8th. We took the trade February 8th when the stock was here. So we didn't play it to go up, we played it to be flat. But if it goes up the way we expect it to, it's a 500% upside potential. And again, that's why I say, 50% not worth it. We can always find something that does much, much better than 50% with our money. So in our portfolios, if they're only performing with a 50% upside, we say, we can do better if we cash out and wait. And that's something traders really hate to do that, but it's a really valuable thing to do. It's just cash out and wait for a really good deal. There's always a really good deal. You just have to look for it. Here's Western Union. That was a good pick. Wow. These are like 100% winners. Here's Pfizer again, because it was too good. Here's gold again. See, individually, it's funny. Individually, we came up with these trades also beforehand. Here's Gilead again. Oh, look. Oh, here's one that might not have worked. Oh, yeah, it did. Nope, sorry. I was like, did that not work? Yeah, it did. This was from December 16th. So on December 16th, we were about $42 on Altria, and it went flying up, but way too high. Look at our target. Our target is $40. We sold the $40 calls. We weren't even expecting it to go higher. We just played it to be flat. This is a dividend play. We're looking to make money on the dividends. AT&T again. IBM. Holy crap! Look at IBM. Wow! Look at this. Look at this in November. Oh my God, it was way down here. That's crazy. And China Mobile, oh, that didn't work out, did it? Well, they got delisted. It actually did work out. It's higher than it was then. The 2672, but now they got delisted. It got complicated, basically. Anyway, so bottom line is always things to play, especially during earnings season. And you just have to see like who goes up, who goes down. Is it for good reason or bad reason or whatever? But, never be afraid to go to cash. Never be afraid to have money to spend. You don't need to be invested all the time. It's not necessarily a good thing. Not being invested and having the ability to grab something when a good deal comes along, that's the real power in trading. I mean, that's what Warren Buffett does. The key to his stuff, it's not just that he goes, oh, I'll buy IBM and I'll buy this one and this one, and I'll buy Coca-Cola. He buys blue chips, but he does what I do. He buys blue chips when the time is right. In fact, there was a Goldman Sachs article today. Let's see if I can find that. Well, I guess I can. Not sure. GOLDM Goldman. Wait. Didn't it say Goldman? Somebody had it. Top picks for a surging economy. I think this said, somehow I got Goldman Sachs in my head when I read this, but maybe. What the hell? Where's the article? Oh, you bastards. I subscribe to everything. I don't really realize that. Sometimes if you click in an incognito window, it'll open for you. Oh, I'm sorry, because I thought this was a. Or sometimes if you open it on your iPad, that's another problem I have. I open things on my iPad, and then Apple seems to be better at reading things that are like this. But anyway, so I thought that was going to be a good list. I'm pretty sure it was Goldman Sachs who had this this list of cyclicals. But you know, stuff like that's what you want to look for. Is like what's cool there. Like I said, just that emissions thing is going to be huge. That's a whole thing we have to watch. This is freaking cool. Conductive ink for printing circuits with ink with an inkjet printer. I mean, how amazing is that? Anyway, so that's the member chat room, of course. What did we talk about today? Oh, we were talking about Netflix, which we shorted a long time ago. We shorted Netflix a long time ago. Didn't work out fantastically, but it was a good trade. We made some good money and got out. But here, you know, again, my target for Netflix is more like $400 to fairly value it. So I don't think it's way over its thing right now. But it's very dangerous to play because they can announce a price increase. I mean, one thing they do is they crack down on family memberships or the way that people share stuff. And I think that's gotten them some backlash because it makes it less attractive. I mean, I know my daughter and her friends, they all share their Netflix accounts. I'd say probably 20 of them have like 5 accounts or something like that. You know, they all watch Netflix, but nobody's paying each one. And you can't expect that. There's a certain portion of your audience that can't afford it. But my daughter I know can't live without Netflix. So that's her. That's how it's the only way she really watches TV. That and YouTube, I guess. Is that for everybody? I have that. Like my kids don't watch TV. Like when they have a hotel room, you know, usually I usually get a hotel rooms next to each other. So whenever I go into their hotel room, they don't have the TV on like the whole time. You know, and it's so weird to me. It's like they all sit there watching TV, but they'd rather watch it on their phone than turn on a great big TV that's right next to them. I don't know. It's weird. I guess you get so used to controlling everything and whatever. For me, it's too small. You know, it's like my eyes aren't good enough for that anymore. Let's see if we have any questions. Still no questions. Well, that's very interesting. Is this thing working? Usually we got a couple of questions by now. All right, looks like it's working. Anyway, so because we're not going to go much longer, so I'll tell you that right now. So if you have a question, ask now or forever hold your peace. This is interesting. 30% tax credit for e-bikes, which is not fair because I already bought mine. I got a Mate. Mate X bike. This is my bike, except it's a cooler color. Nope, Mate X Electric. Yeah, that's what I got. Because I like it because, you know, in Florida, we got the beaches. What does it do? Mine's black. Doesn't matter. Anyway, so you get the idea. But it's very sturdy. I'm a big guy, of course, so it's like I like having a big sturdy frame. It's got shocks in the front and the back. It's got lots of gears. It's got actually very good shifting and gear system. I wish they would have buried this stuff into the handle, though. I don't understand why they didn't do that. It would have been nicer. But I don't like the fact that comes out. But on the whole, though, great bike, very sturdy. The fat tires, I think, are huge because it's just sturdy on the street. And if you're using it for like around town, go get groceries and things. I had a basket thing put on. I got a. What is it? I don't know how to explain it. I have a back thing that's like a piece of metal thing, and on the side of that, I hung 2 saddlebags. So each one can hold a regular grocery bag. So when I go to the grocery store or something like that, I just take the bike. You know, anything like pick up stuff in town or go quickly somewhere. I love it. Freaking great. It's just so much fun. And the other nice thing I found about it from an exercise perspective is having the electric bike gives me a much longer range of how far I'm going to pedal, because I'm not worried about being too tired to come back. Like, you know, you go on a bike and you do 5 miles out and you're like, I don't know, if I have 5 miles, I got to come back 5 miles. This way, I'm like, it doesn't matter. Whenever I get tired, I just go boom, and the thing takes off. So that's good. Also, hills, of course. Florida doesn't have any hills, so that's not really an issue here. But if there was a hill, then we could use the button. We do have bridges that we have the whatchamacallits, the drawbridges that go over the intercoastal. So those have a grade. But yeah, this is a very cool thing. So now, see, now they tell me I only paid $1,500 for mine though, because I bought mine when it was a Kickstarter. This thing used to be a Kickstarter, and so I actually paid money for the Kickstarter campaign, and I think the whole thing all in was like $1,500. But now they're giving you a 30% rebate. So now I get even at 22, you're going to get it for what, like $1,500? So you're back to 15. It's freaking great though. I got to tell you, it's just, I love that thing. But it's just a question of figuring out, like, how do we make money off of these things that are happening? And you have to look at the long-term things. I mean, they're telling you, the government's telling you what they're going to back in the next 5 to 6 years. And so it's going to be things like that, like electric bicycles. People who make electric bikes are going to do well. It's going to be, you know, because I mean, think about China. China's like 90% bikes on the road. Not it's the opposite of us. It's like everybody's riding bikes. And parts of Europe are like that too. Not as much as China, but China's like incredible with the bikes and the bike usage. You know, we have to change. We have to change what we do. We have to adapt. And there's your investing opportunity, though, is thinking about how are we going to adapt, and who's making these decisions. And some of them are going to be consumer decisions, but some of these are, you know, we're in such a crisis that nobody wants to believe, but we're in such a crisis right now that it is going to be government decisions. They are going to tell us that you're going to either pay much more for gas because we're going to tax it until you stop using it, or we're going to mandate electric cars or something like that. But this is the future. Electric cars, electric car charging, carbon capture systems, low emissions, you know, various low emissions things in various industries. You have to look at who's making this stuff and who's making the stuff that's going to be used in the future. And don't play the stuff that's not going to be used in the future. Now, we like Total because they are an alt energy. They have changed their company and they plan to be almost entirely alt energy over the next decade. They're giving up. They've been transitioning out of oil for many years. So we like what they're doing. But I don't like Exxon. I don't like Chevron. You're paying a huge amount of money for oil reserves that they probably can never use. And that's why the U.S. companies are pumping everything they can out of the ground right now. And that's why the U.S. is now the second largest, or maybe the first largest supplier of oil in the world, because they need to get rid of it. They see the oil as a depleting asset that basically, if we don't, you know, it's a use it or lose it for the oil reserves in the United States. And Exxon's got, you know, God knows how many hundreds of billions of dollars worth of oil on their balance sheet, but it's stuck in the ground. Until they pump it out, it's not real. And as the laws tighten and the rules change and people use less and less and less and less oil, then that oil becomes less and less valuable. That's why they can't keep a rally going in the oil patch. You know, no matter what they try to do, it keeps falling because we're forcing demand down. Over the not very long run, we are forcing oil to be cheaper. It's less desirable. We don't want to use it. So we peaked out. Obviously, in 2008, we went crazy, but that was never the case. But basically, here's $100 oil, which is unaffordable. $100 a barrel is too much money. Can't be afforded by regular people. $60 is where you're paying pretty much $75 to fill up your tank by the time it gets to the pump. There's a 42 gallons in an oil drum. So each drum is $61. So the base cost of the oil is about $1.50 per gallon. Then the rest is the refining market. Now, of course, you only get about 19 barrels of gasoline out of a barrel of oil. The rest goes to other stuff, but it's sort of equivalent because you need barrels, and what they do with them doesn't really matter. So 1 barrel of oil yields 19 barrels of gasoline, basically. And if you look at it from that way, your base cost is $3 a gallon, but that's not really true because, like I said, they do. It's not like they can't sell the other 21 or 23. The other 23 gallons of oil do get sold. It's not like they just throw it away as waste products. So, money is made, and that's why the base cost really is just divided by 40. It's easier to just divide it by 40 and say it's about $50 a gallon for the oil. The rest is the cost of refining, transporting, and taxes. That's what you're getting hit at. Now, interestingly, though, what they do to you is if the price of oil goes up, they proportionally raise the cost of gasoline, even though in reality that makes no sense. It's just a material cost. So in other words, if oil goes from 60 to 80, then the cost of the oil in your gasoline goes from $1.50 to $2, let's say, not quite. But let's say it goes from $1.50 to $2 and goes up 50 cents. Well, then gasoline should only go up 50 cents. It still costs the same to transport. It still costs the same to refine. And the taxes are the same. None of that changes. Yet what happens in reality? In reality, they'll knock the price up from $2 to $3 on the gasoline. Or go from $3 to $4. Why? Because they can. That's all. They make a lot more money. It's so funny when you think about it, because if you look back at the history and you see Valero, for example, the refiner, they make this much money when oil is at this price. But here, take a look. Valero. Because Valero is like the #1 refiner in the US. Oh, here you go, 5-year chart, perfect. Okay, so in 2017, they're at $68, and in 2017 they make $4 billion. I'm sorry, we're supposed to look at the price of gas. That's what it's. So in 2017, at $50, they're making well, I forgot the number. So 2017, 50. 2018, we're 50% higher almost in price now. So how did they do comparatively? In 2017, they actually made more money than they made in 2018, even though the revenues were much higher. So in other words, they couldn't raise the price of gasoline fast enough to keep up with the 50% increase in oil. So it's a tricky business, the refining. But sometimes they jack up the price too fast, and what they do is crimp demand. Then, of course, last year, total disaster. This year, not very exciting either. We are long on Valero, though, because they will get back to this. And currently, because this happened to them, they are trading at $28 billion. So $28 billion seems like a lot of money for this, but they're not a startup. They're going to go back to making a couple of $1 billion a year. They can make $3-4 billion a year. But you know what else is going to happen, though? It's going to go down. If we're going to cut our emissions by 50%, that means we're going to cut our fuel consumption by 50%. So it's more electric vehicles, higher mileage, whatever it takes to cut fuel consumption down. That means Valero is going to sell 50% less gasoline in 10 years. That means every year you have to assume that they're going to sell 5% less gasoline. Won't be smooth, it won't be linear, but conceptually, they're going to sell 5% less gasoline a year for the next 5 years, for the next 10 years. So when you're investing in them, you have to think, how long can I live with this? Now we have 2023. We're not worried about the drop between now and 2023. I wouldn't want to own them long term, but we don't mind renting them. But you have to be careful because this number is a depleting number. You don't want to be a super long-term holder of this stock because they're probably going to deplete and deplete. Valero isn't able to pivot like Total has because Total had the money and they've got the resources to go out and start doing other things in alt energy. Valero isn't that way at all. They're a refiner. They own gas stations and they own refineries. They buy gasoline, they buy oil, they turn it into gasoline, and they sell it. But the problem with that is that the government is telling Valero, we are trying to put you out of business. So you have to consider these things when you're investing, and that's why it's very important to pay attention to what the news flow is, what the government is, what Biden is saying. That's why when Biden starts talking, I'm like, oh, what's he talking about now? Because it matters. It does matter. And it's been very tricky the last few years because when Trump says something, you don't know if it's going to happen or not. He doesn't mean it. But when Biden says something, you pretty much know it's going to be like he's really doing this. You know, Trump was like random crap. You know, this is different. This guy's actually setting policy. So there's going to be a lot of changes in a lot of industries, and we're going to have to adapt, and we're going to have to pay attention. But again, it makes opportunities, but you have to be careful and think about, like, why is Valero getting so cheap? Okay, going back to 2 billion, I can justify 14 times earnings, but I wouldn't play them for a home run. But I certainly don't mind. I'm sure they'll earn 2 billion here. They'll probably earn 2 billion, more than 2 billion in 2023, and that's the length of our interest is generally 2 years out. And after that, we're not sure what we're doing with them, and we will reevaluate when it comes to that. So earnings season is a really fantastic time to do this stuff. We're going to get a lot of great information in Q1. I'm generally concerned about, you know, the earnings not justifying the market values that we have now, but nobody seems concerned today. The market's up. Oh, look, questions. Tom says, hey, Phil, could you review the 5% rule again, looking at the S&P or any of the indexes? Oh, my God. Oh, I hope you remember, because that's a big thing, and I'm not going to really get into it heavily now, but quickly, very, very quickly, let's have a little look. SPX. So look, the 5% rule is basically telling you that the indexes will tend to move in 5% increments from their points of consolidation. You have to take my word for it, but the big point of consolidation for the S&P is 2850 over the course of many, many years going back. 2850 is probably, if you took away the stimulus and you took away the tax cuts, 2850, scary as that would be from this height, is probably the fair value for the S&P. It's about a third down from where we are now. You know, we went way, and it seems like, whoa, how are we going to get all the way down there? Well, look where we were in March. So the real value of the S&P is 2850, but we still have Trump's tax cuts still in place, and that's good for a good 10 to 20% hike on that. So that brings you from, well, here you go. I mean, so I say 2850 times 1.2, so 3420. So if, you know, keeping the corporate tax cuts in place, 3420, Biden says he's messing around with them, but then you've got stimulus. So I'd still say probably more like 3420 is where we should be. So bottom line is the 200-day moving average is pretty much correct for the S&P. That's where we should be. Everything else is a gap that's going to close at some point. But anyway, so if we use, so remember 3420 then is the 20% line for the S&P. From there, you say, okay, so what's the 40% line? So it's 2850 times 1.4, and that's 4,000. So we're way ahead of our skis. So this is the, I don't even know what that is. 4,162 minus 2850 is 1312 divided by 2850. So it's about 50% up, right? Yeah. So basically, this is like the 45% line. So 2850 times 1.45 is 4132. So even above 45%, we're almost at 50%. Anyway, so 50%, a 50% run is almost guaranteed to be rejected. It's too fat of a line, it's too much, and we don't have enough volume to justify it and call this a permanent thing. So basically, the 50% line, which I forgot what it is now, is 2850 times 1.5. Here's the best use, it's 4275. So 4275 minus 2850 is 1425 times 0.2 is 285, so 300. So basically, stop it, 2850 times 1.5. So from basically 4,300, your rejections, the rally has been 1,500 points. And therefore, now, so the 5% rule means that all these lines, 5, 10, 15, 20, 25, blah, are all significant lines. 50% obviously very significant point of resistance. You're pretty much definitely going to be rejected there. And considering what we know about the market, we know it's overvalued. We know the stimulus has a limit, that they can't just keep doing this forever. Probably that's going to be the real tippy top of the market is 4,300, even if we plow higher now. From there, you're almost certain to get rejected. And then you have what you call a retrace. A retrace is 20% of the move that you have up. But we had a consolidation at 3,200, right? So since we did consolidate on halfway through the run, we're not really looking for a very large retrace. So probably the retraces are going to be on the run from 32 to 42, which is wow, it's 1,000 points basically. So it's 1,000 points. So we'd be looking for more than 200-point retraces, because this is pretty good consolidation that went on for a long time. And clearly we held up nicely. We were below it, we punched above, we come back down and test it, we hold it, we come back down and test it and hold it. That's good consolidation here. So it had a good almost 6 months of testing before it went higher. Not to mention, obviously, we had all this time we were consolidating below it too. So we'll look at the run as being here is where you start losing control of. From 3,200 to 4,200, we had a real massive run. We know the real number is 4,300. That's where you're going to get rejected. So basically 1,100 points higher times 20% retrace is 220. We'll call it 200 from 43. So that means 4,100 is your first retrace line, and 3,900 is your second retrace line. That means failing the strong weak retracement is 41. That's where we are now. Strong retracement is 39, and if we lose 39, then we're coming back down. Then you've got another, and again, it's going to keep being the same number though. It's going to keep being 200s. We're going to go from 39 to 37, which is exactly where we think we're going to end up. And if we fail that 200 and 400 more, we're going to be back at 3,300 basically. So that's what the 5% rule is about. It's not just the number though. The thing is, you have to look for your consolidation points. You have to use those increments. So when I take a base, and that's the point, you have to know what your base is. We establish the base, we know what it is. We know that it should be higher because of the tax cuts. That's how we get to 32. The tax cut caused us to go from 2850 to 32. Okay, the rest is stimulus, but the fair value is still around here, 32. And by the way, that's because right now the multiple of the S&P, the price earnings ratio, is 35. What should it be? 20 is a stretch. So it should be 15 lower. 15 divided by 35 is 42%. That's scary. So we should be 40% lower. So what's 40% lower? Then we take 4162. Well, not this spot, I'm sorry. So from 4,300, 4,300 times 0.6, 40% lower, 2,580. Oh, well, that's way too low. But, you know, the reality is if in a normal price earnings ratio for the S&P, that's where we'd be. I mean, that's very scary, but that's how much, that's how much 20 times earnings on the S&P are. And it's the earnings that have to catch up. So like I said, that's what they would be, but we have the tax cuts and we have the stimulus, and that's what the story of all this is. But the problem is, even when you're at 35 times earnings, you have to consider that those earnings are being influenced by the tax cuts and stimulus. So everything is sort of like, it all sort of, it's like a circle of earnings, you know, it's just everything feeds off itself. And you get a very distorted picture of how much stocks are really worth and what the market is worth. And that's how you get these precipitous drops. Because in a panic, this is what you found out here. In a panic, nobody was willing to buy the S&P for 2,600. Why not? Because that's where it's valued. And by the way, see where that comes out? Where do we consolidate here on this drop? Right there. Right exactly where the real value is. At 20 times earnings, you consolidate. Okay, then what happens? You go down to 15 times earnings and suddenly people start buying. That's when the bargain hunters come in. But if we have another drop, saying it doesn't matter what happens, another terrorist attack, something, whatever, and you know, we have to go back on global lockdown, because by the way, oh, that was something I didn't mention, which I didn't want to mention it today, but I'm going to just say quickly now that what you need to pay attention to is, where was it? La da da. Here you go. Is this weekly record for new COVID-19 cases was set as of Tuesday. If we gave a shit about the planet instead of only caring about America, we would be concerned. Because as of Tuesday, 5 million cases were reported in a week. 5.24. The record before that was 5.04 in January. So in 3 months, we are quite a bit worse, 5% worse in cases. So 5% more cases per week. That's 3 million people. I don't know. I don't want to get into it, but it's just like 3 million people died last week. Do you feel like we're caring? Do you feel like we're doing the appropriate thing when 3 million people died last week? Are we really taking the actions necessary to stop 3 million people from dying this week? Do you remember the Holocaust? 6 million Jews died in the Holocaust. There were 17 million total people, I think, killed in World War II or something like that, and 6 million were Jews. But that was 6 million. That's 2 weeks of COVID. The whole freaking planet went to war for 4 years to stop the Holocaust. The whole planet Earth got involved in a war. My grandfather, who was British infantry, was sent to India. That's how global this freaking thing is, because he served in India. He didn't see my mother. He never met my mother until she was a little less than 5 years old. Never saw her. She was born when he was away fighting, and he didn't come back until she was almost 5. That's when the first time my mother saw her father. So So the whole world. In other words, she was in India. That's how you really get a sense of how global the thing is. And my other uncle was in Spain. And it was like, I mean, everybody was everywhere. It was crazy. So we sacrificed, we did everything we could, we mobilized, we got all the countries together. There was no question that this had to be done because people were dying. But not at this pace. This pace is just overwhelming. 3 million people a week dead. That's 12 million people a month. Are we acting like the 12 million people a month are dying? Are we acting like this must stop now? And that's what kills me looking at the market. I mean, I'm sorry, that's just the thing in the back of my head when I look at this. I'm like, how do they not care? How is this not mattering? And we've just got so much crap to deal with that we're ignoring this massive problem that is not going away. Yes, we're getting shots and we're doing stuff and so, but it's still not working yet. We're not doing enough. And we're not doing enough because we're not treating it like our top priority. Our top priority is not that 3 million people are dying. We have better things to do, apparently, than worry about those people. And I think that's terrible. I really do. I mean, it's terrible, and it's also, I think, economically dangerous. I think it's short-sighted way of thinking because this could get worse. It is getting worse, despite us getting vaccinated, despite Europe getting vaccinated. It's still spreading like crazy. It could mutate. It could get worse. We could have a strain that's virus resistant. Just like we have virus-resistant bacteria in the hospital. We're losing that. We're losing that war. That's another big problem we have in life. Not virus-resistant. What do you call it? We have anti-resistant bacteria, whatever they call it. But bottom line is, it's not good. You have these things mutate out of control and start fighting off the medicines that you put at it. And this is not how you eradicate a virus. You have to vaccinate. Here's what has to happen. Everybody in the world has to be vaccinated within the course of a year so the virus has nowhere left to go. The problem, though, with this kind of virus is it can be carried by animals. So you can't vaccinate all the animals. So it's a losing battle. It's going to come back. It can hide out and come back, and hide out in your cat and come back and get you, something like that. It can, as it can still spread through an animal population and then come back and reinfect humans. So it's hard to get rid of because it's not a human-only virus. But the only way to really push it back down, though, and get it out of the human population is to make sure all humans are vaccinated, and we have herd immunity as a species, not herd immunity as the United States has herd immunity, so we don't give a crap about anyone else. Because you know what? A year from now, your vaccine wears out, and all the people you didn't care about vaccinating last year are all going to be carrying it and pushing it, and the virus comes back and gets you anyway. And they say, oh, well, we'll just vaccinate again. This only works for so long. Every year we have to come up with new flu shots and new this and new that, and it's just so dangerous to just let something like this go. And we right now there should be a global task force that is vaccinating everybody. The UN should be involved. Things should be happening. It's not. I think it's a big mistake. I'm very worried about what's going on here, and this is really, really concerning. Even if this isn't, even if 3 million people dying a week isn't, 5 million people being infected has got to be a concern. Because this record means this record will go higher too. So I think, I don't know. I don't know what to do. I really don't. I can't believe it's so hard to get people to care about this. JC says, all right, last one, then we got to go. What do you think of KMI in terms of the energy future? They transport natural gas, carbon dioxide, oil on fixed contracts. Yeah, KMI is a good solid thing. Where are we? Yahoo, Yahoo. What the hell? Oh, there it is, KMI. You know, what you want to do is figure out how do they really make their money. So you read the description, they're an energy infrastructure company in North America. They have natural gas pipelines, those are good. Natural gas, blah, blah, blah. Natural gas, blah, blah, blah. The pipeline segment, blah, blah, blah. Now, what you have to find out, though, is are their pipelines being affected by the cancellation of the contracts? Because right now we're halted some natural gas production. And they're in the carbon capture business also, which is obviously a growth field. So they're definitely set up for some good stuff. And the question is, and then you want to see how much is that really, what does that really make? And then I want to take a look over here, find KMI, see if we can get a profile on them, see how they make their money. Nope, unfortunately, they don't have a profile. Some companies have profiles, which is very helpful. I mean, financial profiles, these guys don't have it. So then we just got to do our own research on it and figure out, like, how does KMI really make their money? What's their future and what's their prospects? Now, a shorthand thing, which is very useful from Stockpedia, is they do always quantify the projections. So the basics of Kinder Morgan is they're a $37 billion company and they make nothing. And they're going to make $2 billion. So their PE is about 17 or 18. Figure their PE is about 18. Doesn't seem unrealistic. They're good for 13 billion a year. They think revenues are going to be a little bit less at 12 billion a year, and their profit should be in line at about 2.2 billion. So they are probably fairly priced now. And then the question would be, we'd have to look at them and figure out what is their perspective? Are they going to outperform these estimates that they have? You know, is 2020 a single bad year? So now I want to know what the earnings are going to be. So let's look at Kinder. So what I want to do is pay very close attention on April 21st, which seems to be tomorrow. No, today. That's right, today. So, oh, look at that fat dividend too. Wow, that's interesting. So for the dividend alone, you might want to play them. So if we could construct a good options play, since they're $16 and we probably could, it becomes very interesting for a dividend play. Ideally, we'd like to see them miss today and get a nice discount. So if they miss and we like the reasons they miss, so remind me in chat. If they miss and we like why they miss, we may want to play these guys as an upside play. If they don't miss and they take off, we can still get ourselves a good discount with the options. And for example, see, now if we think that 1660 is a good price to KMI, and again, now they are not going to be subject to the depletion because very likely they're going to get a gain from what they do, from transporting natural gas and carbon waste and so on and so forth. They could actually do very well. But I wouldn't bet on them for spectacular growth. They haven't bet on themselves for spectacular growth. They laid out pretty conservative numbers. But let's say we don't mind buying them for 15. Well, we could collect, and that's kind of hard to see. It's a big wide gap. But let's say we could collect $2 selling the $15 puts. If we can get paid $2 for selling the $15 puts, our net entry is 13. That is a very comfortable 20% discount to the current price. So we could sell some puts, and then we could buy, and then we could either buy the stock. I'm sorry, we could either buy the stock and sell calls to cover. And let's say we sold the $17 calls for $1. Well, let's say it's $1.65. So if we sell these for $1.65, these calls, and we sell these puts for, what did I say, $2? So now we've collected $3.75. That means we'd be buying the stock for $16.69 minus 3 is about $13. So in other words, if we buy the stock, sell the $17 calls, and sell the $15 puts, the net cash outlay is $13. If we get called away at 17, we make 4. which is, you know, about 30% on the 13. And if we, and then of course we will collect the dividend, which was a very nice, I forgot what it was now, but it was a very nice looking dividend, $1 dividend per year also. So in 2 years of owning this stock, we're going to make $5 on 13. So that's 38%. That's a nice rate of return for a little dividend paying stock. Very nice. Then you want to compare that to, like, if we did the options contracts, and let's say that we did the 12-17 spread. Now let's do the 15-17 spread. Why not, right? If we do the 15-17 spread, this is obviously 255 right in the middle, and this is, we said, 165. So that's 255 to 165 is $1.10. So it costs $1.10 for the $2 spread, and we sell these guys for $2. That means we could buy 2 of these for every one of these. So now the question would come down to, how many shares of Kinder Morgan would you be willing to own at 15? Because the net cost of the spread is about 0. So the question is how. So in other words, if I have, what I'm going to be doing then is deciding how much I risk being assigned. If you don't mind being assigned 2,000 shares for $30,000, then we could sell 20 of these contracts and collect $4,000. We can take 40 of these spreads for $4,400, and that means for net $400 out of pocket, we have for the 15-17 spread. So if it goes over 17, you're going to have $4,000 of profit. Okay, that's actually quite a bit better, or not? It's not. I'm sorry, it's not better, but it's as good as, pretty much as good as how much money you're going to make if you do the stock with the spread. But meanwhile, you don't have to own the stock. You're not laying out any cash. So if you have portfolio margin, or if you have ordinary margin in your account, you should be using a lot less of your cash on the sideline to take the position. And what's your worst case scenario? Your worst case scenario is you get assigned Kinder Morgan at $15, which is a nice low price, and then you set up a spread and knock another $3 off the price. So your worst case scenario is more like owning Kinder Morgan for $12. And that seems like a very acceptable worst case scenario. So yeah, this is a very nice way to play. It's a very good stock, pays a very nice dividend. So it's a good thing to establish a long-term position in. Either way to set it up is nice. I would do it with the spread. You're capping your gain at $4,000, but you know that's still, since you get 4,000 back on 400, it's 1,000% gain on $400 of cash outlay. So I mean, that's, you know, it doesn't get much better than that over a 2-year period for investing, right? And again, we're only asking it to go to 17. It only has to go up 30 cents from where it is now for you to make that much money. That's what's crazy about using options for these kind of trades. And your worst case scenario is owning the stock at a 10% discount to where it is now. That's your worst case. And like I said, the worst case isn't even the worst case, because you can knock another 10% off or 20% off by selling more puts and calls later in the cycle. And that's how you control your portfolio, and that's how we get these crazy gains. So yeah, very good suggestion. We should talk about that more in chat after earnings to see how it goes. All right. Thanks a lot, folks. Thanks for coming, and we will do it again next week. All right. Earnings season is going to be fun. We're getting into high gear. Take care.